Let's bring in Kevin Green, senior markets correspondent, to help kind of talk about the action today and what occurred, to just put this all in context. Essentially all of this started with not a tweet, but a post on Truth Social when President Trump yesterday said, quote, "I have authorized a 90-day pause and a substantially lowered reciprocal tariff during this period of 10%, also effective immediately." It just goes to show how quickly things can change. KG, can you give us some framework for how to make sense of all this?
Yeah, I would say it even started with that first tweet from him that said, be cool, it's time to buy. I thought that was actually very interesting. But yeah, you are seeing a little bit of a reversal in policy here. Now, the White House is championing this as a win for now, but we probably did see some fracturing in the market just as a whole. That probably influenced the decision, especially when you're looking at the Treasury market. We started seeing yields overnight spike to the upside very aggressively. I mean, we've seen about a 65 basis point move in a matter of 3 trading sessions, which was really aggressive. And then also what we actually saw was this, the spreads themselves were starting to get really blown out, and it looked like there was an unwinding. And I think there was 3 narratives that were taking place, or people that were thinking could be possibilities. The first one, which would be the optimistic one, people were selling treasuries in order to buy equities. The other scenario here was maybe China was actually unloading treasuries in order to prove a point. And then the last one is this basis trade, which is probably the most likely outcome that we had, where large institutions are buying treasuries, physical treasuries, and then selling the futures. And once those treasury yields started to blow out, they started to unwind those trades, and that's what's pushing yields higher here. And that is actually a big deal when you're looking at the treasury market. Is basically the pipes for the global financial system. So I'm sure that his advisors kind of told him, hey, we might have some issues here. Also, he made a comment around Jamie Dimon's interview on a different network, kind of influenced his decision here. So we are seeing 10% tariffs across the board here, a 90-day pause on the reciprocal tariffs, but then an increase on China by 125%. We haven't seen anything that was really too aggressive as far as a response from China as of yet, but that is something to kind of keep on the radar here. So once we kind of saw that cool down, we started seeing this massive rip to the upside. I think it's the second largest increase or gain that we saw for the S&P 500 in history. So short covering taking place, maybe some speculators also kind of getting in the mix here. And, we'll see if we have some follow through here today. But this is kind of an unusual move, not only for the Treasury market, but for the equity market to get so aggressive like we've seen over the last couple of days.
It does. I mean, even when I was coming in today to the floor, I was talking to someone on the floor about, reminds them of 2008 all over again in terms of just the patterns that we're seeing and the volatility. But in particular, with regard to the bond market, the president, it shows that the president is paying attention. And, I remember, the first time around in office, it seemed like he was paying a lot of attention to equity price action. But this time it seems like, at least from his rhetoric, that he was paying attention to moves in the bond market. And we know Treasury Secretary Bessent has an eagle eye on treasuries as well. And so given I'd heard that narrative about potentially China deleveraging there, but the other factor about maybe moving some of that into equities. In your view, is there a key to look out for in terms of the primary driver from here?
Yeah, I would say probably continue to look at treasury spreads. You can look at the 2-year, 10-year spread. I like to look at the 3-month, 10-year treasury spread. And there were signs there, actually. If you kind of looked at Monday, we were basically going back in negative territory on that spread. So that was kind of the first key note there. And you started seeing very aggressive moves on the short end of the curve, the 3-month treasury, the 2-year treasury. And the reason why we have, there's a problem if you get too low on those treasuries and they don't really connect with the Fed funds rate. And that's really what dries up liquidity and creates these fractures in the market. And I think the writing was definitely on the wall. And so, what I'm looking for is continuing to see that spread try to, see maybe some stabilization and volatility there. And then also how the market's actually going to react over the next couple of weeks. I mean, we still have the tariff policy still looming over us. And we will have an impact when it comes to these China tariffs that continue to ratchet up. I mean, there's definitely different models out there, but there are some models that are saying, okay, well, even with this adjustment to the downside, but that increase with China, you're still looking at around a 20 to 21% tariff rate, a weighted average, and that's still very aggressive. So that's what I would say. And then two, look, I mean, we had a great day yesterday. I mean, I'm seeing it on Twitter and on X. Everybody's championing it, and we're so back and all that stuff. We haven't made a higher low yet, and we haven't made a higher high. So from a technical standpoint, wait until you get that clearance before we get the all clear. Because as you kind of talked about, if you look at the extreme moves to the upside in the market, just like we had yesterday, go back in history and see when did those 8%, 9% moves happen. They actually happened while we were in bear markets. And this is something that could be a little bit of a risk or a little bit of a bull trap right now. We don't know yet, but let the price action really confirm that rather than maybe getting in a little bit too early, because there's still some developments on the horizon here that I think will probably provide some volatility.
So then where do we go from here? I mean, I know we've got CPI coming up today. We finished yesterday at, what was it, 54, 56. And futures indicated lower today. So what's the levels that you're watching out for today to the downside and to the upside?
Yeah, for the upside, looking at 5680, to the downside 5200. It wouldn't be outside of the norm for us to actually have a little bit of a retracement. We should still have a gap on the S&P 500 to the upside, sitting at around 5589. Well, let's say 5590. So you want to be able to fill that as well. And any type of pullback, if we get a pullback and even come back down to that 5100 level, which would be obviously a pretty decent sell-off here, but that could be your higher low scenario here. And I think a lot of technicians really want to see that confirmation, because we have seen very aggressive moves before and have been burned. So I would like to see a fill of that gap to the upside, come back, retest, check it out, maybe get some buyers stepping in, and that's when we rip higher. To the downside, you're looking at around 5200 for today.
Okay. All right. Those are our targets, 5680 to the upside, 5200 to the downside. Thanks a ton, KG.